Welcome back to the channel, everyone. If you're new here, my name's Paula, and every week we break down what's really happening in the crypto markets without the hype, without drama, and without the recycled narratives you see everywhere else. We look at the real macro forces, the genuine on-chain signals, and the stories that actually move price. And this week, there is a lot to unpack. Bitcoin has officially broken below the key $100,000 level. Sentiment has collapsed into extreme fear, and traders across the board are trying to make sense of one of the sharpest pullbacks we've seen in months. So today, I'm going to take you through exactly what caused this drop, why the market reacted so violently, and which upcoming catalysts could determine where prices go next. To start with, let's talk about what actually happened in the market. Bitcoin had a brutal couple of days. On the 16th of November, BTC fell all the way down to around $93,000, marking the lowest point we've seen in months, as multiple support zones failed at once. Liquidation swept through leverage positions, liquidity dried up, and the sell-off accelerated faster than most traders expected. By the 17th, we did see a slight recovery back towards 95,000, but the bounce has been weak and hesitant, showing no real conviction yet. Ethereum followed the exact same pattern, Solana pulled back sharply, and most altcoins have been moving in lockstep with Bitcoin's weakness. Now, a lot of people have been asking why the market dropped so suddenly, and the truth is that nothing in crypto ever moves because of just one event. These sharp corrections are always the result of multiple macro pressures stacking on top of each other. And right now, the macro landscape is extremely tense. One of the most important drivers has been the Federal Reserve. We're heading into a key communication window, and markets are increasingly expecting the Fed to keep interest rates higher for longer. That might not sound dramatic, but for risk assets like Bitcoin, it's a big deal. When interest rates stay high, the opportunity cost of holding non-yielding assets increases. Institutions tend to rotate into safer assets, bonds become more attractive, and crypto gets de-risked. This alone can push prices lower, but this week the shift has been more than just cautious repositioning. Markets are now pricing in the possibility that rate cuts may be delayed well into next year, and that's created a cloud of uncertainty across all risk-on markets. Another major factor weighing on crypto right now is the upcoming US CPI inflation print. Inflation data has been one of the biggest market drivers of the entire year, and traders are genuinely nervous that the next reading could come in hotter than expected. Why does this matter? Because if inflation rises again, the Federal Reserve will have no choice but to keep policy restrictive. So institutions are doing what they always do before high-impact data. They're de-risking early. That means rotating out of volatile assets, reducing leverage, and increasing cash positions. And the crypto market tends to react to this faster than anything else. On top of that, we've got multiple central bank speeches lined up this week, from the Federal Reserve, the European Central Bank, and the Bank of England. Whenever policymakers cluster their public appearances, markets assume the tone will be hawkish, and hawkish central banks almost always push crypto lower. The market hates surprises, so investors de-risk before the speeches even happen. And then there's the regulatory backdrop. In the US, the implementation phase of the Genius Act, the new federal stablecoin framework, has begun, and this week we also saw new draft language for a wider crypto market structure bill. Even though this is American regulation, stablecoins are global, and global traders are watching closely. At the moment, people don't know whether issuers will need larger reserves, whether offshore issuers will face restrictions, or whether certain stablecoins might be forced to change their operating models. When traders don't know how the rules will play out, they naturally reduce exposure, and that adds more selling pressure into an already fragile market. And if that wasn't enough, we're heading into a major Bitcoin options expiry. Options expiries almost always introduce volatility because market makers hedge aggressively as the date approaches. Price often gravitates towards max pain levels, rallies get capped, and sudden wicks become more common. This expiry is a large one, and when you combine that with the thin liquidity we've been seeing, the setup was almost perfect for the kind of cascading drop we witnessed on the 16th. And on-chain data supports the idea that this wasn't just retail panic. This move began with long-term holders. Over the past 2 weeks, whales and long-term wallets have quietly started taking profits. These players always move first. They don't wait for CPI, they don't wait for the Fed, and they definitely don't wait for the market to tell them what's happening. They position early and retail usually follows in panic. This whale distribution lined up perfectly with the macro uncertainty, and once Bitcoin failed to hold 100,000, it created a chain reaction. To add another layer of pressure, global markets have been risk off as well. Tech stocks have been correcting, bond yields have been unstable, and the political tensions in the US have driven a spike in overall market volatility. When traditional markets become uncertain, crypto often gets dragged down even harder. It's one of the realities of the current cycle. Bitcoin still behaves like a high beta tech asset when volatility increases. Finally, we're moving into a time of year where big funds begin their end of year rebalancing. Several EFTs already show outflows this week. Some of it is normal profit taking, some of it is cautious risk management. But when liquidity is thin, even moderate outflows can put noticeable pressure on Bitcoin, especially around key psychological levels like 100,000. All of these factors combined have had a direct effect on sentiment. The fear and greed index has now crashed around 10, which places the market squarely in extreme fear. This is one of the lowest readings we've seen in almost 9 months, and extreme fear typically tells us 3 important things. First, retail sentiment has collapsed. Second, leverage is about to be flushed out of the system. And third, institutional players are watching closely for potential accumulation zones. It doesn't guarantee a bounce, but historically, these have been the times when longer-term investors begin positioning quietly, without fanfare, without headlines, and without hype. Beyond the macro, there are a few key stories shaping the market this week. Institutional flows are one of them. As ETFs rotate and funds rebalance, we're seeing outflows hit the market at the worst possible time. Liquidity is fragile, bid support is shallow, and that's made every sell order feel more dramatic. Even normal rebalancing looks severe under these conditions. We're also seeing caution around the Binance ecosystem. BNB has been under pressure and institutional traders remain hesitant while regulatory scrutiny continues. This isn't the main driver behind Bitcoin's drop, but it adds to the overall risk-off tone. And on the opposite side of the spectrum, tokenization continues to grow quietly in the background. BlackRock's on-chain money market fund is expanding across more platforms, and while this doesn't move the market week by week, it represents a huge shift in how institutional capital will react with blockchain over the next few years. It's not the loudest story, but it's one of the most important. So the question now is, what should we be watching going into the next week? The biggest catalyst, without doubt, is the US CPI report. If inflation comes in soft, markets may stabilise quickly. If inflation comes in hot, the Fed will stay on the defensive, and risk assets, including Bitcoin, could revisit lower levels in the 90,000 region. We also need to pay close attention to the Fed's tone during upcoming speeches, the Bitcoin options expiry, any movement around stablecoin regulation, and ongoing whale activity on-chain. We are in a highly reactive environment right now. The market will respond to every headline, every piece of data, and every shift in tone from policymakers. And while the drop to 93,000 was harsh, moments like this tell us more about market psychology than any pump ever could. Fear is high, leverage has been flushed, liquidity is thin, and the market is vulnerable to both downside shocks and sharp relief bounces. The key in moments like this is to stay calm, stay informed, and avoid emotional decisions. Historically, extreme fear has aligned with opportunity, not necessarily immediate, but eventual. The people who do best in crypto are the ones who can sit through uncertainty and stay focused on data, not emotion. If you found this breakdown helpful, make sure you're subscribed so you don't miss next week's update. And if you want to know the exact strategies we're using in the Crypto Wolfpack to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. Thank you so much for watching, and I'll see you on the next one.